March Madness kicked off this week, and so in honor of the beloved basketball tournament, I decided to make a dividend stock tournament. Here is the bracket. I took the top 64 Dividend Aristocrats, meaning they have at least 25 or more years of dividend growth, and then I also sorted them by highest market cap top to bottom. So the number one overall market cap was ExxonMobil, so that got a 1 seed. And then you had Johnson & Johnson, Walmart, and Procter & Gamble. To determine the winner of each bracket, I pulled up several different very important metrics that I typically look at when I'm first evaluating a stock. This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky. The first matchup, we have ExxonMobil versus S.J. Smucker. The metrics I have are return on capital employed, averaged over the last 5 years. Then I have return on capital employed over the last 12 months. So in this case, you'll see that the average for Exxon has been a rather pedestrian 11%, but the shorter term, only last 12 months, it's increased significantly to 27%. Both of these numbers favor ExxonMobil over Smucker's, which only has 10 and 8. Exxon also has a nearly 7% shareholder yield, meaning dividend yield of 3.4, looks like about 4% in buybacks. Compare that to Smucker's, they also have a buyback, but it's smaller and their dividend yield is lower. Again, this favors Exxon. And then in this column, we've got sales growth in the purple, earnings growth in the dark blue, and then dividends in the light blue. While Smucker's does have a better dividend growth rate, Exxon is clearly superior in both sales and earnings. So I'm also going to give the nod to Exxon. So it's a clean sweep. This round goes to ExxonMobil, and they are moving on to the second round. The next matchup is Sherwin-Williams versus Ecolab. Sherwin-Williams has the superior return on capital employed over the last 5 years and the last year. They also have a superior, but not by much, shareholder yield, which I think is more important than dividend yield, so we'll give the score to Sherwin. And then a massive advantage in the growth department with dividends, sales, and earnings all better than Ecolab. So that one goes to Sherwin-Williams, and they will take on Exxon in the second round. Next matchup, Caterpillar versus Albemarle. Returns on capital go to Cat. We have a tie for the last 12 months, and then a very clear advantage in terms of both dividend yield and shareholder yield for Cat. Albemarle has superior numbers for everything except dividend growth, so we'll give the nod there, but I think in this case, the combination of shareholder yield, dividend yield, and returns on capital employed over the last 5 years is a clear advantage. I also really like that the average is increasing in this case, whereas Albemarle has generally been decreasing. So Caterpillar moves on to round number 2. Next, we have Medtronic versus PPG. Returns on capital, the advantage goes to PPG. Shareholder yield and dividend yield, however, both go to Medtronic. And then growth, we have a mixed bag. Dividend growth is a slight edge to Medtronic. Earnings growth is definitely an advantage. But then sales growth as a slight advantage to PPG. This is a tough one. It kind of comes down to what you prefer, a bigger yield, bigger shareholder yield, or more impressive returns on capital. I'm going to give the nod to Medtronic. I would normally favor the returns on capital, but I do not like that this is seemingly consistently eroding, whereas Medtronic is lower, but at least it's been stable. And you've got the slightly better growth numbers and much better yield. So Medtronic is moving on. Next, we have Enbridge versus Stryker. Both 5-year average numbers are declining. So I'll give the nod to this 13% for Stryker. I'll also give the nod to the trailing 12-month at 12. However, it's worth noting that this has also been in decline. Yield and shareholder yield gets a major advantage for Enbridge, but then we also have a major advantage to Stryker for growth. Each of these numbers much higher. So in this case, I'm going to go with Stryker. I tend to favor higher returns on capital and faster growth above a high dividend yield with pretty weak profitability. So this round goes to Stryker. Next, we have NextEra versus Church & Dwight. Returns on capital both go to Church and Dwight. Yield and shareholder yield go to Nextera. And then growth also goes to Nextera. I'm going to give the nod to Nextera in this case. I think the growth numbers are quite a bit more compelling, a slight edge on shareholder yield and dividend yield, but I think the real kicker and the thing that concerns me about Church and Dwight is this very clear and substantial decline in returns on capital employed over the last 12 months. It's a close one, but I'm going to go with Nextera. Next, we have Becton Dickinson versus Parker Hannifin. Here we get the nod for a higher return on capital. Both of them are deteriorating. However, Becton Dickinson is very concerning, a very clear erosion in both numbers, all the way down to a dismal 6%, which is truly terrible. You also have some downside here, but at least it's staying at the 13% level. Shareholder yield and dividend yield are almost a dead tie. And then the growth goes to Parker Hannifin, other than sales growth at 5.7. That favors Becton Dickinson at 9.3. But other than that, Parker Hannifin takes this one. Next, we have Chevron versus Clorox. A very clear victory on the 5-year average return on capital. However, just like with Exxon, you see that the higher energy prices that we've seen have boosted profitability quite a bit for Chevron, whereas Clorox has been on a bit of a decline. So this is about a tie. Chevron gets the clear nod for shareholder yield. It's close, but they also get the nod for dividend yield. And then growth numbers are superior across the board, except for a slight edge on dividend growth. So in this case, I'm going to give the victory to Chevron. I do not like this deterioration in returns on capital for Clorox, whereas Chevron, assuming energy prices stay high, should continue to get this favorable economics. Next, we have J&J versus Expeditors International. Most people would probably assume J&J would take this round. However, when you look at the underlying economics, there's a clear victory for Expeditors in both the 5-year average and the trailing 12 months. You also have a nice uptrend in both, a little lumpy, but generally heading higher. And look at this, a whopping 10.4% shareholder yield. The dividend yield is obviously higher for J&J at almost 3% versus 1.2, but this buyback is tremendous, so that definitely would favor Expeditors. And then consistently better growth across the board. You do have kind of this one-time spike in J&J's earnings. Again, I think that was probably a one-off scenario. The sales growth and dividend growth of 4 and 6 are probably more representative, whereas here with Expeditors, you're getting almost 10% dividend growth with 20% sales growth and 25% earnings growth. So this round, we get an upset. The 16 seed Expeditors takes down powerhouse J&J. Next, we have 3M versus Roper. You've got a deterioration in returns on capital for 3M, and you have the same thing for Roper. The numbers are higher for 3M, so they'll get the victory, although this is a very sharp decline. You don't like to see that. Yield and shareholder yield, not very impressive for Roper, whereas 3M, you've got obviously a massive dividend yield of 5.8 and shareholder yield of 7.7, so that takes that one. And then growth is a bit mixed. Might get a slight edge to Roper for the 12% dividend growth, but you see a pretty anemic sales and earnings growth, which is concerning. Really the same thing here for 3M, 1.6% sales growth. That is terrible. Dividend growth is also slowed substantially, which makes sense, right? Because dividends can't continue to grow at over double-digit levels whenever sales and earnings are growing at less than 5. So neither one is particularly compelling, but we will give the nod to 3M. So they're moving on. In the next round, we have IBM versus WST, which is West Pharmaceutical Services. So here you've got a major edge to WST. Not only are returns on capital higher at 22 and 25 compared with 13 and 12, but IBM is consistently deteriorating both metrics, whereas the exact opposite for WST. So this is very, very impressive. Yield and shareholder yield are the same, but that nod goes to IBM. But then WST absolutely smashes IBM on growth, or in this case, shrinkage. Earnings are down 22% for IBM. Sales are down 5. Dividend growth is down to 2.2. Whereas on this side, WST grew its earnings at 31%, sales at 12.5%, and the dividend at 6.6%. So WST dominates IBM and moves on to the second round. Here we have Brown-Forman versus ADP. Returns on capital moving higher and at higher levels for ADP, 43 versus 25. The trailing 12-month, 65%, and again, moving in a upward direction, whereas not only are these lower numbers for Brown-Forman, but they're both trending lower. Yield and shareholder yield both quite a bit higher for ADP, whereas only 1.3% dividend yield, no buyback for Brown-Forman. And then growth is higher on all three metrics for ADP by a pretty healthy margin. So ADP with a dominant victory in round one has an interesting matchup with WST in the round number 2. Aflac versus Canadian National Railway get the nod for returns on capital. Very nice shareholder yield for both, 6.5% versus 8.8 gets the victory. And then earnings growth isn't as good for CNI, 0.4 versus 2.7. But they do have better sales, and then dividend growth is very similar in both cases. So this is a tough one, but I think the shareholder yield is still pretty impressive, even though Aflac is 8.8. The higher return on capital numbers catch my attention, and I also don't love the consistent deterioration in returns on capital for Aflac, whereas at least here for CNI, you've got some upward trajectory. These are very close, but I'm going to give the nod to CNI. Next round, we have Hormel versus Linde. The 5-year victory goes to Hormel, but the 1-year victory goes to Linde. They're also in a clear uptrend, whereas Hormel does not look good on a trailing 12-month basis. Shareholder yield is actually less than dividend yield for Hormel, so they're issuing equity, which I do not like, versus a 4.5% shareholder yield for Linde. And then the growth numbers are substantially better for Linde, very close on dividend growth, but this round goes to Lind. Next round, we have APD versus the beloved dividend payer Realty Income. Absolutely anemic returns on capital for Realty at 3 and 2. It's just pitiful versus Air Products at 12 and 11. Also very alarming, the dividend yield is 4.9 for Realty, but the shareholder yield is negative 6.2. So they're issuing a ton of equity. That is not good. So major victory here for Air Products. And then you also see more consistent growth across the board. The only thing is on sales growth, which favors Realty, but this one easily goes to Air Products. And here we have Coca-Cola versus Cardinal Health. Interesting here on the returns on capital, Coke declining and also has slightly worse numbers than Cardinal Health, which has absolutely exploded in the last year. They also have a major advantage in shareholder yield at 10.7%. That gets the nod, and then a nod as well on sales growth and dividend growth. The only thing you don't like is this negative 14% earnings, whereas Coke is plus 50. I'm not exactly sure what the reason is for those. I definitely don't believe Coke's going to grow that fast forever, but surprise upset victory goes to Cardinal Health. Now moving on to the other side of the bracket, we have Walmart versus FDS. So both companies have shrinking returns on capital, but you do have a slight advantage at 25% and 18% for FactSet. Shareholder yield and dividend yield both go to Walmart, and then the growth goes to FactSet. This is another really close one, but I typically would favor returns on capital over shareholder yield slightly, and then the tiebreaker goes to FactSet for better growth. So FactSet moves on to take on the winner of EPD and Cintas. Here we have much better numbers for Cintas at 22 and 28, plus a generally increasing pattern, whereas very inconsistent and lower for EPD. Shareholder yield and dividend yield both massively favor EPD. But on the growth front, you see 23% dividend growth and 23% earnings growth versus just 2% dividend growth and 13% earnings growth for EPD. Sales have been a bit better for EBT, but I think the nod here is going to go to Cintas. S&P Global versus Genuine Parts. Slight edge here for S&P at 25 versus 18, but on the trailing 12-month, you see that SPD has fallen off a cliff, or SPGI, sorry, at 7, whereas you've got some improvement for Genuine Parts at 22. The shareholder yield for S&P Global is amazing, 12.2%, a massive buyback program that they've done. And then the growth has also been consistently between 12 and 15%. So this round goes to S&P Global. Next, we have Chubb versus ES. Returns on capital, not impressive for either, but you've got 8 and 11, plus a little bit of improvement here versus decline for Eversource. Shareholder yield of 4.5 versus 2.9. And growth is overall pretty mixed, so we'll just call that a tie, but I think Chubb gets the overall round. Next, we have Target versus ED. Improvement in returns on capital and a higher number, whereas this just looks dismal. Also dismal here at 6 versus 13. Shareholder yield is 6.6 for Target, much better than 3.3 for ED. And then the growth numbers have just been absolutely anemic for ED, actually negative earnings growth, whereas at least at Target, we've got some sort of earnings growth, and then sales and dividends have both been better. So the easy win goes to Target. And here we have Lowe's versus Spice Maker McCormick. You see major victory here for Lowe's at 41 and 46 versus 13 and 11. Also have downward trajectory for both of these, whereas upward trajectory for Lowe's. Shareholder yield is massive. I think the highest we've seen yet, almost 14%. And all of these are substantially higher sales, earnings, and dividends. So Lowe's absolutely smoking McCormick. Next, we have Colgate versus Kimberly-Clark. Both of these are a bit troubling in the way they've rolled over recently, but both are pretty impressive on a nominal basis. At least 47 and 39 gets the nod. Shareholder yield of 4.2, slightly better, although you do have more of this coming from dividends for Kimberly-Clark, whereas Colgate has a lower yield, but more of a buyback, so it's probably a bit of a wash. And then the growth numbers also not great, but you do have probably a slight edge to Colgate. This is kind of tough. I think you probably would go with Colgate, although this is definitely concerning for both businesses. Next, we have Pepsi versus WP Carey. Easy wins for returns on capital for Pepsi. Another situation here where the dividend yield seems to be impressive at 5.4, but they're issuing equity at WP Carey, so that drops the shareholder yield to 2.4. It actually gives the victory to Pepsi at a 3.2. We also see better earnings growth and dividend growth, so this one easily goes to Pepsi. So Pepsi moving on to face Colgate in the next round. Next matchup, PG versus ATO. Procter & Gamble's returns on capital have been improving and are also nominally higher versus declining, and a weak 7 and a very weak 6. Shareholder yield is negative. That looks bad. Positive 4.9 for Procter & Gamble. And then you also have better earnings growth, but better sales and dividend growth over here. But this negative shareholder yield and terrible returns on capital just doom ATO, and PG gets the easy win. Next, we have Emerson versus Archer Daniels. Looking at the nominal numbers, you give the victory to Emerson. However, the pattern, the decline is not good. There's a bit of an improvement, or at least a sideways motion for ADM, which you like, but probably still the slight nod here. Shareholder yield of 7.3 versus 5.7. But then it looks like the growth, Archer Daniels takes it with 22% earnings, 10.8% sales, and 4.6% dividend growth. So I think this is really a tough one. You're basically pitting improvement in returns on capital, even at a lower number, versus declining numbers. Better growth, shareholder yield slightly better for Emerson. This is close. I think I'm going to go with ADM, but I have a feeling they're going to struggle next round against PG. So we'll see. An interesting matchup here, Cisco versus T-Rowe. Very high returns on capital for T-Rowe at 35 and 24. However, doesn't look good, whereas you got some improvement here for Cisco. So you probably get the victory here, and here you give the nod to T-Rowe going back 5 years. Shareholder yield and dividend yield both favor T-Rowe. And growth is close, but a bit mixed, so we'll call that basically a tie. So this is another close one. I think you give the nod to T-Rowe just for that big shareholder yield and also the relatively high returns on capital. But I do think you want to pay attention to this right here. If this continues to fall, that is not good for T-Rowe. but they do enough to advance, and they'll take on the winner of TRI and WBA. So here we have Thomson Reuters versus Walgreens. The edge goes to Thomson & Reuters here because it's at least improving, whereas WBA is on a steady decline. Also, this price chart looks terrible for WBA versus TRI moving up. I don't usually point that out, but in this case, it's very dramatically favoring TRI. Don't ignore that. Returns on capital the last 12 months, 11 versus 4. That is terrible. Shareholder yield and dividend yield favoring WBA. And growth looks to be a push. I think here the higher and improving returns on capital for Thomson Reuters and the much better looking historical price chart trumps the higher shareholder yield. I'm taking Thomson Reuters. Next round we have ITW versus Grainger. Very similar numbers here, 35, 44 versus 33 and 40. I'm going to give the slight nod here to ITW for the consistency of this improvement, and maybe the victory here for just trailing 12 months. The shareholder yield victory goes to ITW. And then earnings, probably a slight nod to Grainger, 24 versus 15, 6 versus 12, and then 7-9 versus 2. This is another really close call, but I think I'm going to go with ITW. I really like the way this is consistently moving higher. Returns on capital employed. And then the 4.7% shareholder yield, that's probably the icing on top. So ITW takes that one, and we have 3 more games to go. Here is Raytheon versus Dover. Returns on capital, pretty dismal for Raytheon, so Dover takes that one easily. Shareholder yield is basically a dead tie. Dividend yield's a little higher for Raytheon, but the growth is very clearly better for Dover as well. So this round goes to Dover. And next we have General Dynamics versus Nucor. And Nucor is going to sweep this one easily with a 30% and 42% versus 16 and 14. Also a nice shareholder yield at 8.2. And the growth has just been amazing, 47, 15, and 6. The only thing you don't like is just a massive, seemingly run up because of kind of one-time increase in earnings. So this consistency is a little worrisome, but it's certainly better than this downward trending returns on capital for General Dynamics. So Nucor takes this round. And in the final matchup, we have McDonald's versus Cincinnati Financial. Returns on capital are an easy victory for McDonald's, 24 and 25. Similar yield and shareholder yield, but a slight nod goes to Cincinnati. And you do get a nod for Cincinnati as well on earnings growth, and pretty weak, but still better than McDonald's sales growth, which is only 0.3%. McDonald's does get the edge on dividend growth at 8%. All in all, I think these numbers are too strong. Takes this round. So there it is. The first round of the Dividend Madness is in the books, and we have 32 teams, 32 stocks remaining to move on to the next round. I'm planning to do that next round next week. And then my plan is, as we move forward, I'll get increasingly more detailed in the analysis. So probably by the time we get down to the final 4 or the final round, I'll do an in-depth research into those 2 stocks that make it through. But for the sake of time, I wanted to keep this video just real high level. I had a lot of games to get through. So hopefully that was helpful. I think this is kind of how I typically look. Whenever I don't know anything about a stock, I like to look at those charts. And if you're interested in those specific charts, how to build them, you can use the link in the description down below for a tool that I personally subscribe to called Portfolio 123. You can do back testing, build custom formulas, do fundamental charting like I did there. You can add a whole bunch of different metrics on that, and it's a really nice way to just see at a glance what a stock fundamentals look like. A lot of times you can just look at those and say, nope, not going to buy that, and just move right along. So it really helps speed up the process. This video is not sponsored by them at all. I just really like the service. Also, I'll put a PDF to this in the link in the description down below. If you want to download this and fill out this bracket on your own. If you do fill it out, be sure to, tag me on Twitter or send it to me somehow. I'd love to see what you would choose as your overall best dividend stock. So let me know in the comment section down below which stock you've got going all the way. And if you have any ideas for how I can make this more interesting or things I should look at in the next couple rounds, I'd love to get your ideas on that as well. Thanks for watching, and we will see you in the next video.